Hello, fellow Rebel Capitals. Hope you're well. So I have got two of my good friends on to talk about how to invest for trumponomics. The next 4 years, the Trump administration. Today is the inauguration, and a lot of things I've heard, positive, negative, a mix of both from Trump out of his speech. But it's going to be a lot different, obviously, than the Biden administration. So how do you make outsized returns? Hopefully, how do you make 10x returns? And like I said, there's no better two guys on the planet Earth to talk about that and give you the strategies that they're using for their own hedge fund and portfolio than these two gentlemen right here. So guys, introduce yourself and let's get into the conversation. I'm really excited.
You want to go first, Brad?
Yeah. Thanks, Chris. So my name's Brad McFadden, and I live about 3 hours north of Melbourne in Australia, in amongst the hills. It's really quite beautiful. It's summer here right now, so it's pretty hot. Lots of.
And you guys manage a fund together, don't you?
That's right.
You are all about. You're the two head honchos in the Glenorchy Fund.
Yeah, I guess it's probably more important than where I live. Yeah, we manage the Glenorchy, too early in the morning. It's 6 a.m. here, so excuse me. The Glenorchy Macro Value Fund, essentially investing in really out of favor sectors and markets across the globe.
Yeah,
which is where we sort of gain the outsized returns because no one else is looking at these markets, or very, very few.
Okay, and Chris, everybody pretty much knows you from Capitalist Exploits, and Chris McIntosh, my good friend and partner with Lynn Alden and Rebel Capitalist Pro. Is it fair to say that you guys specialize in commodities, or that you guys specialize in things that are cheap, relatively speaking?
Kind of the latter.
Just tended to be commodities over the last couple of years, especially since COVID.
It's commodities now, but it's like one of those things I like to say. I'll buy sardines if that makes sense. I don't give a shit. but
the real question, Chris, is would you buy Trump coin?
I'll tell you what, I don't know for sure, but this could be the straw that breaks the meme coin back, because
really
this is, well, think about this. Okay, we've had all this pro crypto hype coming into the inauguration, right?
Yeah.
Then on the back of it, he goes and he issues Trump coin, which runs to 30 billion. And by the way, the Trump family own 80% of what is locked up capital. So they just made $24 billion by issuing a coin which does absolutely nothing.
Right.
Okay. So now you're going to have a whole lot of MAGA pro people who bought this thing and put their life savings or some portion of their hard-earned capital into this thing because they feel so emotional, which is terrible if you're an investor. Right. Feel so emotional about everything that's going on. They put their hard-earned capital into this. I've never, ever seen anything like this which ends well. Like, you can't issue a coin out of thin air that does absolutely nothing and have it retain value for any length of period of time. It's going to be the same as the bloody monkey JPEGs that we were laughing about, 10 years ago?
Or fart coin, or butthole coin, or any of these other crazy contraptions.
So what happens when these people find out that because at some point the Trump family is going to want to liquidate some of those billions of dollars, and they're going to need some chumps on the other side of that trade. I cannot see this ending well.
Yeah, and it's not just that, because a lot of people will say, "Oh, it's not an intentional rug pull by Trump," and they have Melania coin as well. I'm sure you saw that.
Yeah, I saw that
today or the day prior. And they say, "Oh, there's a lockup period, so this isn't a pump and dump." Yeah, it is. It absolutely is, because although Trump might not be dumping, I assure you, there are other people within the space that are taking advantage of this and will absolutely be pumping this along with Trump and Melania, and they will be dumping. And because the float's so low, you're going to see massive volatility. And then, yes, when the Trump family, if they do sell, they're going to be unloading that onto the bag holders. But the real problem that I have with it is, where's the integrity? right? Like does Trump really? Trump has to know that the majority of the people that buy into this are going to lose money. It's
Yeah.
just it's human nature. It's
Yeah.
the way the retail investor works. It's the hysteria, the mania, and he's doing it anyway. And I mean, it's
The point
to
that
me, it's
you've made
disgusting.
very well, which
Disgusting.
I wasn't eloquent enough to make, which is it's not so much about that you can't issue something which doesn't have value. It's the fact that you are the incoming president,
Yeah,
knowingly issuing a coin which is backed by nothing and has no value and never will. It's one thing to sell T-shirts or caps or paraphernalia, which you could say, oh, like the cap you're wearing, right? We could sell that for $50 and make it for $5 in Guangdong. Okay, you can argue and say, oh, well, you're kind of raping people. Look, people have the choice to buy the cap, and it's a $50 cap, and it's maybe got some branding behind it or whatever the case might be. That's completely different to issuing a useless coin which doesn't have any functional value, knowingly doing so, and knowing that the only value behind that is around emotion, and that emotion will subside over time. And when that subsides, there's nobody to pick up the other side of the trade.
yeah.
And as you say, people will lose money.
And let me just say that in clearer words: Ponzi scheme. He set up his own Ponzi scheme. So the president and the first lady have effectively set up their own Ponzi scheme. And this is the world we live in. I sent out a tweet earlier today where I said I could see the emperors doing this as Rome falls into oblivion. You know, this is exactly like what you would see them do as society completely crumbles. That we've got to this point. And it's not just about, well, who cares? Everyone's doing a meme coin. It doesn't really matter. You know, what's more important is Trump's policies. No, I completely agree that what's more important is Trump's policies. My issue is, like I said in the tweet, why are we not making integrity great again? I mean, to me, that's kind of the principles that built this country. And anyway, I don't want to get too far down.
Well, look, George, this is important in terms of what we're going to talk about and why we're invested in what we're invested into, because what we're actually just watching here is simply late stage empire politics. If you go back and you study history, this is precise. Like, if you studied history and you didn't know where we were at now, the things we're watching, you would be like, oh yeah, of course. No, that's completely normal. That would be to be expected in a late stage empire.
Right.
So none of this is actually unusual. None of it is surprising when you understand history. It's completely within what should and does happen in late stage empires. And so the way we look at these things is, don't get caught up in the noise. Don't get caught up in whether Trump's issued a coin or not issued a coin, or whether he's going to take Panama or not take Panama. All of this shit is late stage empire. What does that mean for financial markets? What does it mean for cycles? We are at the map redrawing phase of cycles. We're in that 250-year evolution cycle. We're at the end of the monetary cycle. These are known facts, right? You don't need to care whether Biden's in power or Trump's in power or whether Macron's in or not. Like, to some extent, none of that really matters, because it's a little bit like, I like to say that narrative follows price in markets. You know, like, you'll have something happen in price, and then you'll start seeing the pundits come out on CNBC and explaining why that might be the case. Oh, it's because the Fed raised rates. This is what happened. And then the next time the Fed lowers rates and the same thing happened, and then they have to try and, you know, explain why that is.
Yeah.
It's similar. So you have this setup where people are always trying to explain what's going on, and they're looking at the short term, at the noise. They're looking at whether it's Trump's in and what he's doing here, or whether Melania is doing. Like, none of that in the context of history really matters, because the simple economics is what ultimately drives those major trends. And the simple economics is such that we are in a massive indebted cycle. That debt has to be repaid in some shape or form. With respect to Trump, I think he's going to run the economy red hot. That's what he's going to try and do. And that's going to be inflationary. I think geopolitically, he's going to pivot to spending more time on North and South. If you look basically throughout the Obama, then you had Trump, and then you had Biden, there was like a West-East play largely.
Yeah.
Now they're going North-South. He's trying to capture that entire North-South. That's why Greenland, Canada, Panama are all on his radar. That's why he's super chummy with, or at least Elon is, with Milei down in Argentina. They've come out and they've been saying Maduro's got to go. So like that whole region there is where I think he's going to pivot towards politically and militarily gaining more solid control. So in that respect, I actually think,
or the Middle East and China.
Yeah.
Okay.
So in that respect, I think there's, and we're already invested in this. I think this bodes extremely well for like Argentina. I think he's going to start opening trade and pushing politically to have that. So you're in Colombia, right?
Right.
And you got elections coming up in 2026. Do you think Petro is still going to stay? I don't.
Almost a zero chance.
Is zero. So, and then you look at what's happened in Argentina. It swung, shall we say, right, or at least conservative, or at least business oriented, right? Very heavily so. You got Chile coming up in 25 November this year, and Boric's out for sure. Like people are, it's a similar dynamic to that which you've got in Colombia.
Okay.
So I think that there's a decent probability that South and Latin America, which is very cheap, gets repriced, and you start getting trade deals and a whole lot of other things that is going to be influenced by the US. But again, how do you play that?
How does Brazil fit into your equation?
Brazil as well. So Brazil, what are we? 26, they got elections. I don't know, but like you go back and you think about when we started getting invested into Argentina, that was in October 21. That was like 2 full years before people didn't even know Milei existed.
Yeah.
And the market started pricing. You could see it in the chart. The market started pricing something other than what had been in the past. Markets are forward looking. So if you look at Brazil now, it's cheap for sure. Equities, I don't think you have to go and buy it tomorrow, but I think equities could start rallying in the next 12 to sort of 18 months in Brazil. Again, it's like what we're looking at is risk reward. It's not like you're actually trying to make a play and say, Brazil politics is going to get better or worse. It's looking at something and saying, okay, if it doesn't change, how is it priced? What is my risk?
Yeah, right.
And so, if something's down 80, 90% or something of that variation, and your PEs are sitting at 4, and it's in a sector that you like, then you know what the downside is, right? Because if there isn't any political change, it's like, not a whole lot happens. Maybe it goes down 10, 20% or something, but that's not catastrophic. On the other hand, your upside on that stuff could be 5, 10 times. And that's, so if you look at what we've done in Argentina, which we're still extraordinarily bullish on, I mean, we're up. What are we up, Brad, on like say Banco Macro?
Probably, I guess on average, Chris, probably 5x from when we first got in, late 2021. That's across. There's about probably half a dozen stocks.
Yeah.
Chris, let me actually phrase that a little bit different, because I think what you're saying is so important, not just for Brazil, but from a standpoint of the concepts you're talking about and how to become a better investor. So it's not just about buying things when they're cheap. It's about buying things when they're cheap and then finding a catalyst, because things can stay cheap forever, and then you're just then you have the opportunity cost.
Mhm.
But you have to find things when they're cheap and then find a catalyst. And also too, it's not just getting the catalyst right, but it's trying to figure out what the spread is, if you will, currently between perception and actual probabilities. So you
Yep.
talked about Malay and Argentina when you guys got invested in Argentina. Let's just say when you guys got invested, the perception was there, let's just say was a 3% chance that Malay would win. That's what the market, that's the perception of the market. And that's what was priced into the market, where you and Brad did your analysis and you said, no, it's not 3%. It might be 20%. And so even if Malay doesn't get elected, if the perception or the probabilities the market is attaching to that event just go from 3% up to 10% or 15%, that's going to have a dramatic impact on the investments that you guys made. So I just wanted to try to explain the kind of the strategy behind those investments that you guys made and why they actually worked. It's all about trying to figure out that catalyst and then the delta between market perceptions and actual probabilities.
Yeah, and that can, and then you get a feedback mechanism where it starts moving in a particular direction, and if it's favorable, it's like self-reinforcing. And I think in Argentina we're in a self-reinforcing cycle at this point.
Yeah, right.
With respect to catalysts, if you look at what are some of the topics that Trump has been pushing, and he's done it before the inauguration day, he's called the climate hoax a hoax. He's called it a climate hoax. And so you go, okay, well, what does that mean? Well, it means largely that all of these sort of green initiatives, all this woke nonsense, austerity, all of that goes away, or at least is curtailed to some degree. That's within the US. But now you look at Argentina. What has he done? He's done the same thing. He's called it a climate scam. He's called it all woke nonsense, and he's opened up for drilling. And so these are very positive for commodities. You're seeing a similar thing now in Europe. Like, people are pissed. They've had enough of this austerity. They've had enough of this green woke nonsense. So you see it in Slovakia. You're seeing it now at the AfD in Germany. People don't want that anymore. They just want growth. They don't want climate nonsense, right? So,
Chris, so I understand why that's good for commodities and society at large, the human race. But why is it good for commodity prices? And maybe, Brad, you can explain your view there, because it sounds like what Chris is saying is just more supply. And in that case, it could be negative for the commodity price. Although, again, that would be beneficial for humanity, because we all know energy is at the root of the standard of living.
Yeah. So, gosh, where to start in terms of?
I mean, do you think that the demand increases as a result of these, and that demand exceeds the additional supply that would come online due to those policies and the narrative change?
Possibly. Look, okay, so there's commodity prices, and then there's actually, and obviously there's commodity producers. Let's say Exxon, right? Produces oil.
Right.
Right. Now, then you have the companies that actually do all the grunt work for, say, Exxon, like, let's say, onshore drillers, offshore drillers, companies that do subsea services. So very, very few people. So what you can have a situation, George, is the price of oil doesn't do too much. Just take oil, for example. It goes sideways, whatever, $80 plus or minus for the next, I don't know, 5 years, whatever. But no one's actually focused on those companies actually doing the grunt work, getting out there and drilling or doing subsea services, etc. And so you can have a situation where, just for example, just take offshore oil drillers. It's a very, very small subset, but day rates can increase on the drillers and increase quite dramatically because CapEx is picking up. The oil price might not necessarily do too much, but day rates for drillers can improve dramatically. Likewise for subsea service companies. And what we've done is sort of try and figure out what the weakest link is and what's going to be most responsive to capital flows. Again, I think you sort of highlighted before, everyone here sort of focuses on the big things, Chris, like the price of oil. It's like, yeah, okay, we've got a funny feeling it's going to rise. We've got a funny feeling that shale oil will disappoint, and the Permian Basin is probably already in a mature phase, so on and so forth. But what we're very, very sure of is there's just a lack of supply, lack of capacity to drill, to perform subsea services, to link all the stuff up, so on and so forth. And that's where we find out the asymmetry. I guess it gives you a bit of an example of what we look for. It's almost like a second order effects of.
Yeah, that makes a lot of sense. So with the producers, or with these people providing the picks and the shovels, so to speak. It's just the price of oil. It's also the lack or reduction in regulation that gives them access to maybe supply that they might not otherwise have had, because it lowers their overall cost to get that barrel of oil out of the ocean or out of the ground or whatever it is, and therefore they need more picks and shovels. And if you're investing in those companies that are currently cheap to provide those, then that's where your upside is. And then if the price of oil goes from 80 to 100 or 120, then that's just icing on the cake.
It's a free option. Yes.
Yeah, there you go.
Exactly.
What you got to remember, George, is we've had this net zero bullshit. So all of the major banks signed up to net zero.
Yeah.
And so what you're looking at there was a starvation of capital into the fossil fuel industry. And they've all, by the way, they've all killed that now. JP Morgan was the last one, I think a month ago, or maybe 3 weeks ago, turned around and said, no, we're exiting the alliance. It was a banking alliance called Net Zero. Mm-hmm. And all of the major banks now have turned around and kicked it to dust, kicked it into touch. So what and part of that possibly is also them looking at the incoming administration and going, we're on the wrong side of this.
Yeah.
Right? We want to make money. Like they're there to make money. They're not there to save the climate or anything else. Don't be silly. They're capitalists. They're just going to look at which way the political winds blow, and they're going to adjust their sails accordingly. But
they're the oil version of Mark Zuckerberg.
Exactly. Exactly. You turned around. Well, wasn't me. It's pathetic. But look, so what's important from this, and Brad's absolutely correct, we don't need oil to do anything. But what you get is a rotation of capital whereby capital can now enter that space. And the other component that's super important to understand is that on a cyclical basis, we've had a lack of capital investment, the order which we've never really seen before within that space. Because A, you had the commodity cycle, and then B, on top of it, to exacerbate it, we had all of this green woke nonsense and a whole raft of legislature globally which suppressed investment into the fossil fuel industry. So you're looking at this incredible shortage of capital that has been spent. And the other component, of course, is that this is a very capital intensive sector. We can't turn the oil on tomorrow just because Trump's in power.
Right. So there's
you're
a long
go and drill for it.
Chris,
then you go. Well, firstly, you're gonna fight with, even if this is in, say, the United States.
Yeah.
You're gonna have to go and fight with some greenies to acquire some land, and you're gonna drill for some oil, and then once you've found it, if you're lucky enough, I mean, some of the stuff they know exists, but I'm just sort of laying out a typical, from zero to hero exploration through production phase. And then you're going to have to build the infrastructure, whether it be rigs or whatever, mines. And again, there'll be a whole raft of approvals. And you can fast track those, but it's like bureaucracy is still bureaucracy. And by the time you actually get into production, it's multi-years. multi-years, and huge capital investment, billions of dollars. So, you know, when investors are placing capital, they have to be secure that they're going to get a payback after 10 years, something of that variation, especially in these intensely capital intensive types of industries, like a drill rig offshore. You know, it's going to cost you what, 1.2 for a rig, 600 mil odd for an OSV. You'll need about 4 of those to service the rig. Like you're banging straight into $2-3 billion just without blinking an eye. And so your investors that are prepared to put up that sort of capital need to have some surety of returns over time. This is not stuff that just happens tomorrow because Trump said so. It doesn't work that way. So, but it will start the capital flowing. So in other words, the capital will start flowing into the sectors, but it doesn't mean that you're suddenly going to get oil, right? To the extent that people think. And that's, you know, Brad mentioned how we anticipate shale will disappoint, and we've written extensively about that. But I think politically, you know, the change in that we're seeing now, it simply potentially opens the gates for capital to start moving into a space that has been starved of capital for well over a decade. But and the trend, and it's in line with the trends that are already there. You know, we're already in a commodity cycle whereby we're in the sort of depths of it. We just published an issue now last night, I think, and we're highlighting, you know, the differentials that you're seeing, which is this entire sector, as well as value, quote unquote, value stocks, has been absolutely starved of capital. At the same time that everybody's running into meme coins and Nvidia and
so guys, I want to talk about other commodities for sure, because I know you guys are experts at investing in things like uranium and coal and gold and silver and all these things that I think are very topical. For the people watching right now, this is just a surface level discussion. And on Thursday, we're going to be doing a deep dive webinar. I'm very excited about it. So if you want the link for that webinar, it's a free webinar. You just go to georgegammon.com/birthday. Now, this is an email list for the virtual conference that I'm doing on my birthday, January 30th. But for the people that are on that list, we're going to be emailing them the link to attend this deep dive webinar we're doing on Thursday with the three of us. So I just wanted to make sure I mentioned that. So if you're really enjoying this conversation and you want to have more of this type of content, we're setting that up for you for Thursday, I believe 3 p.m. Eastern time. But if you go to georgegammon.com/birthday, put in your email address, we'll email you the link once it's set up. Okay. On that note, guys, what are you, outside of oil in the commodity space, what are you guys really excited about as far as kind of risk reward? And I guess it doesn't really have to be in the commodity space. It can be something else.
Brad, you want to take it? Yeah.
Well, if we take the energy complex, this is where things get difficult. You take the energy complex, so what have we got? You've got oil, you've got coal, natural gas, I guess you could say uranium as well. Well, let's forget wind and solar. That's just and then you have the companies that service these companies, be it offshore drillers or whatever. Okay. The real tricky part, George, is like which one's going to. They're all cheap.
Yeah.
And it's like, well, which one is going to outperform? It could be coal, and here and now you can buy coal miners and you get on a P of 5, and it's ridiculous. So for us, it's a tricky one. Well, what do you concentrate on? So we haven't really. We've got exposure across the board, not knowing which one really is going to be the real big kicker. and how long it will take. It's all very well to say, yep, a catalyst. Yeah, well, we've got plenty of catalysts in mind. But sometimes these things take longer to work out than you think. It can be a couple of years. It can be 4 years. It's one of, I guess, our big competitive advantages. We don't handicap ourselves by having to have something perform within a couple of years. We can sit and wait for 4 years as long as we know there's a big pot of gold at the other end. And there's another the shipping. Shipping's another one. There's massive possibilities in that. We can start getting to agricultural.
Why are there massive possibilities in shipping, Brad?
It is the lack of. It's the aging fleet. So within a few years, I think that within about 4 years, about 30% of the world's tanker fleet will be over 20 years old.
Yeah, and they have to change, what, like 25 years or something?
Yeah, generally over 20 years, the next voyage is to a beach in Bangladesh for many ships.
Yeah.
So and it's been very, very difficult to get finance to build ships, because who wants to provide finance for ships? I mean, that's boring stuff. The shipbuilders, there's only half the capacity of shipbuilders that there was 15 years, I think. So even if you want to get a ship built, who's going to build it for you? What's the cost? So on and so forth. So even if money starts flowing, you're just not going to see an increase in capacity in ships for quite some time. And this has always been the enemy of the sort of cyclical commodity industries. It's like, prices rise. Well, we'll fix that. You get a massive flood of capacity come online, and bang, freight rate, day rates crash, freight rates crash, so on and so forth. Commodity prices crash. This is a little bit different. As Chris said, there's been a starvation of capital going into this whole broad, I don't know, theme or sector, call it what you will, industry for, I'd say more than 10 years, Chris, now. Because
it's running probably about 16, 17 years
yeah,
now.
you could argue, well, pick a figure, but it's a long time. So, and I think our biggest risk of all these things, George, is when things start moving, the bull markets that result from all this will surprise everyone, including ourselves, in terms of duration and magnitude. Our biggest risk is getting out of these things too early. It's all very easy to buy these things when no one wants to touch them. And, you hold on for a couple of years and then they take off. And it's really, really difficult to let winners run for you. I mean, as I said, as Chris and I said, we bought Argentina late 2021. And that's gone up like about fivefold for us on those initial positions. Of course, we bought it along the way as well. But it's really, really difficult holding on to winning positions, but that's what you got to do. A long way of saying, of not answering a question, George, what's going to be the best one? What else have we got in there, Chris? Well, actually, we've started buying Chinese equities now.
Just
recently. Chris, how
do
you see AI playing into the energy space? Who do you think are going to be the winners from AI? And by the way, I talked to Rick Rule about this the other day, and although he thinks that will definitely increase the demand for specific energy, he thinks the even bigger story on the demand side is just the emerging markets, just people going from a bicycle to a 50cc motorcycle, and from a 50cc motorcycle to a Hilux. He thinks that will move the needle on the demand side even more than AI.
Yeah, look, I think AI is similar to what we saw with, say, internet stocks or any new technology that comes along. I think in general, human beings over anticipate what it'll do in the short term.
Yeah, right.
And then under anticipate what it'll do in the long term. So much in the same way with, like, you think about the .com era, everyone's like, the internet's going to change the world. Buy pets.com or like whatever. And you had all manner of garbage, and like 80-90% of these things washed away and went away, and they took people's livelihoods with them. Okay. But did the internet change people's lives? Absolutely. The businesses that you and I that we're all running are built on that infrastructure. Absolutely. It's completely changed our lives.
Yeah.
But that's over a much, much longer time frame. That's 25, 30 years ago. Okay. So in the short term, people over anticipated things and they bought into Cisco and a whole lot of things, which then ultimately crashed. And then out of the rubble, if you will, of that, there was actually something there. The internet was a real thing. And I think AI fits into a similar bracket. We're seeing this extraordinary push in terms of capital being invested into things that I don't think are going to actually ultimately make people money. And we've got a number of clients in Glenorchy who work in that space, directly in that space. And all of them have told us the same thing.
Yeah.
Most of what is being promoted as AI is not AI. It's simply just automation. But you call it AI and you get a multiple on your on your valuations, right? Just like we could have had a business that was selling flowers and we called it flowers.com and suddenly we were worth $100 million more. So, so we're in a similar situation today, I think.
So
And
how does
then
that, when it does start to really, really change society and change the way we live, whether that's 3 years or 10 years, how do you think that impacts the energy space? Does it, do you think they're going to be sourcing most of that from nat gas, from
I
nuclear?
think it'll be geographical. And so
Okay.
like in the United States, likely it'll be natural gas because that's what you have. Right? If you are in Kazakhstan, guess what? You'll use nuclear because you got a ton of uranium. So it's going to be geographic dependent, but it's obvious to us that it will the demand for running these AI data centers is going to be extraordinarily energy intensive. So and so you can actually look at the cost of energy globally. So there's often the question posed of who's going to win that AI race. And one of the things that I've been looking at the charts is cost of energy globally. And in that respect, China basically wins because they just have a much lower cost of energy, cost of electricity at this point in time. There's other parts around the world which are somewhat better and somewhat worse, but and in large part, a lot of that is down to regulation. It's not down to the access of coal or whatever it is. A lot of it's actually a bureaucratic friction point that is causing the cost of that energy to be what it is. So anyways, on that front, China sort of wins at this point in terms of aggregate electricity. Then you can get into chip making and there's a whole lot of other things. I don't think at this point in time, it's not something that's on our radar because while this is interesting to talk about, it's like one of those things where like if you don't have an actionable outcome and you go, okay, well, how would we play this?
Yeah, right.
And is it worth playing at this point in time? So I don't think that there's any there's nothing on our radars where we look at that's in the quote unquote AI space where we go, yeah, that makes sense from a valuation perspective.
Yeah.
And so you just leave it alone.
Chris, this is perhaps, I guess it highlights our way of thinking and approaching things, George. So the AI thing. We're talking about natural gas and AI, and okay. So in essence, the AI thing for us is a free option. Yes, we think it's going to be a dramatic increase in use of energy, and it's going to have to be. You can't build a nuclear power station; it's going to take too long. Those things all run at full capacity. Sure, you could take. So forget that. That's dreamland stuff. The energy is going to have to be made up by natural gas, and when natural gas goes, so does coal. But let's leave coal out for the moment. Where this actually gets to, George, it's like we're not going to stake our lives on it, but it could increase dramatically the demand for natural gas. Okay, but our base case is that natural gas is going to be supply surprises to the downside, negative supply surprises for natural gas in the US. That's what we've been thinking about, so on and so forth. So at the moment, these natural gas producers are very, very cheap, producing fantastic cash flow returns. And this AI thing, that's a free option on top. and you're not paying. You can buy these natural gas producers, and you're not paying any premium for the massive increase in demand that might come down the road from AI.
Mm-hmm.
That's, I think, the way we sort of look at it. And
Yeah,
we're always trying to look for, okay, what's the base case? What are these companies producing good cash flows as it is, and where can we get a free option? Now, Argentina is a classic example. When we bought into these companies back in late 2021, you're buying Argentinian banks, for example, on a P's of 4. Well, Millet wasn't even talked about. I don't think even we thought about Millet, but we had a suspicion that there might be dramatic social and political change coming. But that was a free option on top, because if nothing happened, well, these companies just keep on producing cash and voila, no problem.
yeah.
So that's how we sort of approach the AI thing. It's a sort of a free option. We've got our suspicions on it, but if the AI thing fails to come through or deliver in terms of what everyone's anticipating in terms of energy demand, it's like, well, no big deal.
Yeah, what's nice about the Argentina play versus the AI impacting energy play is with Argentina, you had a specific date that there would likely be a catalyst. In other words, the election. You know, unfortunately, we don't have a specific date with AI where it could just go one way or the other. If we had that like a year and a half from now, that would make it a lot easier, because then you would know if you're on the right side of that trade, and if not, then you've got to reassess. You wouldn't just be kind of watching your watch, waiting as the years go by, which might happen with AI. How do you guys think about the metals space, like not just with gold, but with more industrial metals like copper?
Less bullish. To some extent, we had some of the base metals in our portfolio, and in some respects, they were a hedge against us being wrong, because our thesis was quite simple. You had these extraordinarily cheap valuations in the fossil fuel, broadly the fossil fuel sector, if you will, if you want to call it that. And at the same time, you had this renewable push. The renewable push, if you look through what was that they were looking to push, wind, solar, battery technologies, most of that is predicated on copper demand to some degree, because a lot of the byproducts that are required for, say, battery manufacturing, a lot of those components are actually byproducts of copper mines. And so it's not like you can just go out and get X. It's like it requires copper. So we had some long positions in that, which was to some degree a hedge against our long positions in things like coal and uranium. And we both feel like that narrative is finally broken. You know, we're seeing, and it's both from a political standpoint, which is Trump's coming into power. We're seeing it again in Europe. You're seeing this. People, like I said, people are fed up with this woke nonsense, and they're now electing people that are wanting growth. And growth basically means going back to things that actually work, not putting up windmills in Germany, and actually, anyways. So you've got both a political change, but the political change has been predicated by an actual economic necessity. So in that environment, I think there's going to be less incentives and less capital flowing into the quote unquote renewable space. And again, that was part of it for a little bit, was a bit of a hedge for us, was owning that. So we're less bullish on base metals, if you will.
Yeah.
George, the actions of the big mining houses tell us all. I mean, we're contrarians, and sort of what are we doing? Sort of the opposite of what most others are doing. You take Anglo American, BHP, Rio. What have they been doing over the last 5 or so years, particularly like the last few years? They've been just offloading their coal assets. I want to touch that toxic waste. That's just, politically unacceptable. They're getting rid of that. and focusing on, and particularly BHP. Look what they've been saying. Oh, we want to focus on the energy revolution, what do you call it? The transition materials,
the ESG stuff.
Yeah. So, well, copper is one of them. Of course, there's lithium and others as well. But let's just take copper. So they've been very, and nickel. They've been very happy to develop those assets, and they've just been offloading coal. I mean, you take BHP and Anglo American. They used to have their fingers in so many different pies. Including energy, where it was obviously at one stage it was oil and gas as well, and coal. But they've just been offloading those things like there's no tomorrow. So that's where we find the opportunity, and they've been offloading those assets, George, into less financed, smaller companies. So you're trying to so let's say you're BHP, right, and you want to increase your production in coal. Well, fine, we'll just take some cash flows from copper and goodness knows what else. We'll start focusing on coal production. But if you're a small miner, sort of dedicated to mining coal, where's the increase in? Where's the capital going to come from? You're not going to get any loans. That's dead. Banks don't want to do that. Might be changing a bit now, but anyway. So it has to be financed internally, like with equity, with operating cash flow. So anyway, long way of saying it. Just look at what the big mining house is doing, and that's a dead giveaway of where the opportunity is and isn't. It's not in copper; it's in the assets you're getting rid of, and that's
yeah. It could almost be. You could almost turn that into an investing rule, Brad. Just not always, but you always need to consider fading a company that is doing something for political reasons.
Yes,
because usually that will backfire on them. And like we've seen lately, and that's where the opportunity actually lies. I've got a totally random question for you. Have you guys looked into BYD? And the reason I say that, Chris, is because for people outside of the United States, they won't know what the hell I'm talking about. But you guys are world travelers. And you guys travel just as much, maybe even more than I do, to these different countries. And every single time I go to an emerging market, not every emerging market, but the vast majority, let's say, of emerging markets I go to, all you see are BYDs. And every single time I go back, I see more and more and more and more and more of not just Chinese cars, but more specifically those BYDs. And I know it's trading a little expensive now, maybe 20, and I know it's expensive for a car company. Yeah, but is that on your watch list, just out of curiosity?
Yeah, it's I just in the last issue we just talked about auto companies. We were highlighting Volkswagen, basically a lot of the European ones. And the reason I bring this up is so synthetically getting to BYD. Basically, you're right. I mean, if you go throughout Southeast Asia, even Middle East, Dubai is littered with these damn things, and they're really nice. They're actually they're making some really, really nice cars now, and not just BYD, but a lot of the Chinese brands. And what we're watching is that on a domestic basis in China, and certainly in Southeast Asia, there is no real need anymore to buy European cars. Their own cars are as good, some say better. I'm not an expert in that, so I won't opine. But certainly for the price that you're paying, it's very, very competitive. Now you couple that with the Europeans who are trying to sanction the Chinese on a whole range of different things, basically saying that they're undercutting them, and it's just politics. And then you couple that with the fact that, of course, Putin blew up his own pipeline, which meant that Europe now has been operating on much, much higher energy costs, with what is a fairly sclerotic union-based system. And they're just collapsing. These European manufacturers are collapsing. And so when you're in a survival collapse mode, your technological advancement, your R&D
Yeah.
That goes away. Like the first thing you're going to scrap in any business is R&D. Like you're
And
just in
marketing,
survival
right.
mode. So I think within the next decade or two, I think the divergence between, just in terms of quality of manufacturing, I think the divergence is going to increase in favor of China. And then it comes into whereas, because there's the other concern that people have is the demand. If the Europeans are not going to be buying Chinese vehicles as a consequence of laws that are being put in place to sanction them to some degree, who's going to buy them? And so this is where I think China's moving fairly aggressively towards a domestic consumption type of economy. This has been discussed quite a lot by people far more knowledgeable than myself, and I don't think they're there yet, but certainly they're moving towards that. So what that means to some degree is that your base manufacturing isn't going to be predicated on an export-driven model. I think there's probably a time frame there where things have to readjust to some degree. So it's not something we'd dive into yet. But if you said to me, which would I rather own, Volkswagen or Daimler Chrysler, or I think it's Cattle, which owns BYD, in 10 years' time, like if I had to make the trade now and I can exit only in 10 years' time, it'd be a Chinese car company because they're currently cheaper, and I think the trend is in their favor.
And another thing too, Chris, that I wanted to add just for the American viewers that I guarantee you very few of them ever think about is, the backlash there is always, well, they're cheap, they're cheap, they're cheap. They are cheap. And the reason they're cheap is because they're super slow and they're incredibly unsafe. But that's the advantage, right? Because people need to understand that when you get into countries like Colombia, there are no highways. There are no freeways.
You're not buying a Lambo.
That's right. The fastest, and I'm not making this up. The fastest you can drive in Colombia, or Medellin more specifically, is probably 35 miles per hour. That's the fastest you can drive on any road, even if you have a Lamborghini, because the roads are the roads just aren't straight, for heaven's sakes. So my point there is, if you have a Mercedes Benz, they're going to make that with the safety standards and with the horsepower to drive on the Autobahn. Where BYD isn't going to do that because they're more catering to these emerging markets where you can't drive over 35 miles per hour. Therefore, the priority is never, ever, ever going to be on safety, and it's never, ever, ever going to be on speed. And that's, in my view, where the real growth is in these emerging markets, where those are the priorities, as opposed to the priorities that you would have in Europe, the United States, Canada, etc.
The other thing that I've seen and I was talking to Miha about this because he's based in Bangkok now. The financing that the Chinese manufacturers are doing make it, I mean, that they've got entire finance, like most large car manufacturers, they have entire financing arms.
Yeah, like Ford.
But what you're seeing, for example, just in Thailand's a good example of an emerging, broadening, burgeoning middle class. So where you had people who were buying scooters and tuk-tuks and whatever, they're now moving into vehicles. And the difference between going from like the scooter to the vehicle in terms of the way they're financing it isn't that big a leap. So
Right.
you're seeing this shift where people are now buying vehicles. So like families will have at least one vehicle, where previously they'd have maybe a couple of scooters to get around on. And again, so they're catering to that market. And then your Europeans will look at this and say, well, as you mentioned, that's not, the car's not as good as this, that, or the other thing. They don't care. They're not making the car for you.
Yeah.
You're inconsequential.
Exactly. So, guys, I want to talk about soft commodities as well, and a few other topics, especially gold. And I'd like to talk about Bitcoin in addition to that. But before we get there, I want to ask you just one thing quickly that occurred to me the other day. And I think for me, this is a really, really good a local indicator, but maybe I'm crazy. So here in Medellin, you've heard about the middle class growing very, very quickly, especially since I got here 10 years ago. But what they just built here in Medellin, they started building it maybe 2 years ago, was an Ikea. And it dawned on me, I'm like, wait a minute. Ikea is going to spend probably billions of dollars a year in market research. And in order to build an Ikea, they've got to drop, what, $1 billion? Well, we're not, because you're talking about having to move all those supply chains and do all that stuff, which is very, very expensive, in addition to building out the facility and hiring all the employees and the managers. I mean, that is a huge time suck, and it's a huge capital suck. And their target demo is obviously the middle class. So I thought that's actually kind of a neat strategy where you could just go around the world and ask yourself, what city are they building an Ikea? And that would give you pretty much everything you need to know about the middle class in that area. What do you guys think of that?
Yeah, it's interesting you say that. So, like years ago, I worked for JP Morgan, and we had this. It was another department. They had a fund they set up in the US, and what they were doing there, I'll get to why this is similar. They would take any town, any small town, city, whatever you want to call it, that had a population of 150,000 or more. Okay, and so when it got to more, they didn't want something 250, but sort of around that metric. And then what they would do was they would just go and buy raw land 10 kilometers out from the city center. That was it, nothing else. And basically, it was just years and years of study and history. And what they found was that when a population hit that 150, that's when you got like an explosion, because there was now enough people that you would say, okay, we need a school. Well, we need some schools. And then when there's schools, there's kids, and people come with kids, and then then the kids get sore teeth, and they need a dentist, and then they need a doctor, and then
There's a mall.
They got no shoes, and they need a shoe shop, and like everything just explodes. And so, but the greatest asymmetry lay in the 10 kilometers out, because at that point in time, people were going, that's fucking way out of town. What do you want that for? So you were paying cents on the dollar for your real estate. And that was, anyways. So back to your point, where you've got that dynamic, as you mentioned, Ikea would have done their market research. They need to have a certain volume, because that's a volume business.
Yeah.
And so, why are they choosing that as a location? It's because they not only is there sufficient volume now, but they're predicting that there will be, on an ongoing basis, sufficient volume.
Not just sufficient, but growing.
And then by them taking that action, there's a self-fulfilling prophecy, insofar as people will go like, oh, did you know that Medellin's got an Ikea and X city doesn't? Well, so it's an attractive thing, because now you have access to resources and access to goods and services which are cheaper than elsewhere and else. So it's an attractive thing, and that brings more people. So it's a smart way to go about looking at. And you, as a real estate investor, of course, would be perking your ears up.
That's kind of the angle I was going with it. All right, guys, what about soft commodities? I've heard, what was really cheap? Was it sugar that was getting super? Maybe that was just like 6 months ago. I don't follow it too closely.
We don't. The problem with soft commodities, George, if you're going to play it, you basically got to play in the futures markets, and that means leverage. So, you think about, say, we've talked about energy. Like, you can play in the energy markets because you can work all the way down the supply chain. You can pick a driller, you could pick a pipe manufacturer, you could pick ExxonMobil if you wanted. How do you do that in sugar?
Yeah.
It's very difficult. So in most instances, you have to go into the futures market. We don't like and don't use leverage. And
like short Hershey's chocolate or something.
But there, you see, it doesn't like, because that's now a consumer good. It works on a different.
Yeah.
Yes, you could have the cost of your chocolate gets more, or your coffee or whatever gets more expensive, but it doesn't. And the interesting, so like you talk about coffee, right? Because I was talking with a friend of mine, and he's an ex-coffee trader, and he's like, no, coffee prices are going to go up. He's very, should we say, bullish on coffee prices.
Really high, aren't they?
They're going to get more expensive.
Okay, yeah.
But one of the things with coffee is that like that is basically a recession-proof type of industry. People still buy coffee, even in recessions, and so it's like there's interesting dynamics around certain, especially food products. They tend to be somewhat more like, shall we say, recession-proof. But again, it's like the ability to actually trade that. You start working into the equities that might have sugar in part of their production or coffee or whatever it is. But now you're looking at a whole different dynamic. And in many instances, you look at them and they're not cheap. So you're like, we don't buy stuff if it's not cheap, basically.
Yeah, right. So I want to talk about gold now. But before I do, I want to give you guys some a little insider information here. Can you guys see this?
Mm-hmm.
Yeah.
So that, I don't know if you can't really tell how shiny it is, but this
looks pretty shiny.
Mike Maloney was here visiting the other day, and I let him look at this, and he guessed that there was probably about an ounce of gold in here and probably a couple ounces of silver. And what this is, it's actually a gift. I've been going to a gold mine here because they got a lot of mom and pop gold mines in Colombia. Most people don't know that. And there's this mountain that's about 3 hours south of Medellin where they've been mining gold for 400 years. And
Wow.
it's all, it's this little town of about 1,000 people. And there's probably 100 of these little mom and pop, literally hole in the side of the mountain where they just have their little claim. And then they go in there with a donkey. And I'm not exaggerating. And then they go in there with their donkey, and then they come out with like a plastic bucket full of rocks, just like this. And then they throw those rocks into the grinder. I'm sure you guys have seen this process.
Yeah.
And, they just got a little tin roof over the grinder, and that grinds it into a coarse sand. And then they take the coarse sand and put it into another grinder where it grinds it into a finer sand. And then they literally just have this big sifter with the water, and it sifts out the flakes from the rock. And then they just take the flakes up, the little flight of stairs to the guy's little office. He's got a big safe there, and he just melts the gold down right there. But my point is that I went up there and we did a video that we'll be releasing. But we went there about a week or two ago, and I was talking to a lot of these mom and pop gold miners, and almost all of them are buying new equipment and these big grinders. They're buying ones that are better and faster. I think as the technology has improved slightly, and every single one of these miners was buying these grinders from companies that built them in China. So I don't know if there's maybe a company that's on your guys' radar in China that builds this stuff, but if so, I know they've got a lot of demand coming from Colombia. So there's your insider intel.
Interesting. Tell me, do you think their ability to pay for that is a consequence of them being more profitable, or is it just the cost of the actual units that are now falling to the point where they're like, we can afford now to buy this grinder, which was previously maybe twice
I think it's
the
the price. I think you hit the nail on the head, Chris, because if you think about like this guy that I've been working with down there, I know all of his numbers. I mean, he was very, very open. And when they get, for every ton of this that they pull out of the mountain, they get about 25 grams of gold and about 50 grams of silver. And according to our calculations, he does about 40 tons a day. Wow. So when I say mom and pop, it is a mom and pop operation with donkeys and, like Doug Casey says, choo-choo train business. But this dude's doing 100 grand a day based on on current spot. So if you think about that, if he's doing 100 grand a day today, well, when the price of gold was, let's just say 2,000, well, he wasn't doing 100 grand back then. He was doing whatever, let's just say 85,000. Well, that's an extra $15,000 a day now that he has, because the majority of his costs are fixed, as you guys know. In fact, I don't even know what cost he would have that would be fluctuating. It's pretty much almost 100% of his costs are fixed. And so therefore that additional $15,000 a day, he can afford to invest in CapEx, but all that CapEx money, just FYI, is going to China and the Chinese producers that build these picks and shovels for the mines.
Interesting. Huh. No, we've not looked into
I see Brad's writing it down. Anyway, what do you guys think about gold right now?
Start searching for gold crushing equipment out of China. It'll
Yeah.
be interesting to see whether, the volumes on that sort of stuff. Wow. Yeah, look, I mean, on precious metals, we're at the end of a monetary cycle. We're long. We just haven't got like some sort of all giddy about it. Precious metals have got their space, they got their place. And I think as we go through this monetary reset, then at some point, I think gold will shine a lot. We're about 5% roughly weighted into it, so we're not,
But for you guys, it's more of an insurance policy, isn't it? Other than just a...
Yeah, because we'd look like idiots if gold went to $5,000 an ounce. We weren't there.
Yeah.
That's fake.
I guess that's true. And Brad, what do you think about Bitcoin? And then after you tell me, I'm going to go ahead and give you guys my base case as to where Bitcoin, gold, and the dollar go over the next 5 years.
Geez. All right. I maybe I'm a disgruntled post office worker. That's a bad joke, isn't it? I do recall looking at this thing called Bitcoin in 2013. I think it was like $400 for a Bitcoin, and going, yeah, what the hell? Another bloody fad. So I am embarrassed to say I didn't even put $1,000 into it back then. Like, okay, look,
But Chris, you owned it for the fun, or for some of your managed accounts.
Yeah, we did.
Yeah.
Yeah.
I just get this feeling, George. Maybe I'm just too much of I'm an old fart. I've been around the block too many times before, and I've seen too many things. It's almost like this whole the tulip thing.
Yeah.
The tulip mania in the Netherlands back in the mid 1600s. There's utility out there. Okay, there's no doubt there's utility with this Bitcoin thing, but there's a whole lot going around it, which is just complete speculation
And hype, yeah.
and hype, and that always ends in tears. This has gone on a lot longer than I thought it ever would. How it ends in tears, I don't know. I just get the feeling, George, is too much money, too much silly money out there. Chasing too many dumbass concepts, and inflation will okay, put it this way: if we see oil at $100 a barrel 12 months from now, pick a figure, 18 months, whatever, what is will we start seeing money flowing out of this whole Bitcoin craze or cryptocurrency track craze into oil? Is it just a sign of the times? I'm very apprehensive, but I'm just apprehensive, George, because I run away when I see rampant speculation. To me, it always ends in tears. So I try and find other things.
Yeah, to me, it's like the .com thing where I think there's a fundamental case for Bitcoin that I really, really like. I always say that I think everyone should own Bitcoin to have purchasing power outside of the system, because to have decentralized purchasing power, especially in today's world, is fantastic for those who value their freedom and liberty. But there is a huge component of the price, obviously, that's speculative. But I think once that, if that comes out, then you're basing the price on fundamentals. And for the fundamentals longer term, I'm very bullish, because I'm very bearish of governments, central planners, and authoritarians.
Yeah, look,
you know what I mean?
I'm also a child of the .com bubble. I went through it. I was 30 years old in 2000, so it wasn't as if I was like 10. Yeah. And I saw Amazon fall. Look where Amazon is now. It's like, oh well, fantastic. But Amazon did fall 90%.
Yeah.
And many of these other companies just went away. At one stage, Cisco was the biggest company in the world. Not so much now. So yeah, I've seen the speculation before, George. It ends in tears, but what Chris said before is right. Yeah, the internet did change things.
Yeah, it's all about time horizon. All about time horizon.
Yes, yes.
personally
It's
think-
very, very hard picking winners, George. I mean, who the hell was to know that Amazon was going to be the winner of this? The bloody thing sold books back then. Like
Yeah.
now it sells goodness knows what. Who could have anticipated that? So, but I'm not helping too much here. I just find so much good old fashioned value elsewhere. I can go buy a coal miner. I know that I'm going to get a full payback on my investment after 4 years.
Yeah.
Easy.
I actually think that if we got into a time machine, I think the probability is high in just, let's say, in 5 years. So we eliminate, just kind of the short-term noise and vol and all that stuff and speculation and hype and mania and whatnot. I think my base case would be that gold, Bitcoin, and the dollar are all higher. Obviously dollar relative to other fiat currencies. And I think that most people, especially as of 2019-20, always thought that gold was like the inverse of the dollar, even against other, on the DXY. And we found out that that's absolutely not true. That they can, and the way I see things playing out in the global economy over the next 5 years, I think it's risk off. And I think that that's very beneficial for the dollar. And I think you're going to have liquidity issues. And I think that's good for the dollar. And then in the times when you don't have the liquidity issues, I think it's still risk off. And that's good for gold. And hopefully, once Bitcoin kind of decouples from the mania, it'll be beneficial to that asset as well.
I think if you look at the whole Bitcoin thing, it's back to the analogy that we talked about before with respect to new technology and how we over anticipate in the short term and so on and so forth. What you're looking at is a technology that is far superior to our existing financial infrastructure. In other words, simply to move capital of any description around the world is absolutely no question that blockchain is massively superior.
Yep.
Okay. You can do it in seconds. I can send you something now, wallet to wallet. It doesn't have to be Bitcoin. It could be USDT. It could be any number of things. So the underlying technology is transformative. And so now you go and then you look at the existing infrastructure, which is it's being weaponized, right? And increasingly weaponized in order to meet political objectives, whether it be sanctioning Russia or whether it be sanctioning Venezuela or whatever the case might be, or even at a domestic level where you don't want company X to send money to company Y. That infrastructure is being weaponized, and blockchain is an alternative to it. Mm-hmm. The best blockchain that we have, from my understanding, being having rudimentary knowledge of this, is Bitcoin.
Yeah.
Okay. So when you look at it from that perspective, I'm like, yeah, that's something I should own. But it's not something, and we've said this, or I say this to clients. Brad and I disagree to some degree on this, on Bitcoin at least. But I say, look, if you're going to own it, there's no point in us owning it in a fund for you. It's retarded. One of the main reasons that you own it is so that you have self-custody. You don't rely on, because if we're going to buy it for you, guess what? We have to buy it through an ETF or something.
Yeah. And then the only part of the decision-making process is price go up or price go down. If you guys are paying, because that's your job, that's the reason that's not the only value of having Bitcoin.
Correct. Yeah. I agree with you on the dollar side of things. I think there's the mechanisms that you've got globally are that we have it's a credit-based monetary system, and the vast majority of vast majority of credit in the world is dollar-based credit, and simultaneously the dollar is being weaponized. So any contraction in credit, especially external to the US, which is a fantastic weapon if you have it, and it's now being utilized, that's dollar positive.
Yep.
That's
And
very
why?
dollar
Let
positive.
me just explain why. Because it's a contraction in supply, because those dollars were lent into existence. So if on net you have more loans being paid off, then the supply of those dollars are decreasing. And in addition to that, the velocity of those dollars are also decreasing, which is why it's positive for the dollar relative to those other fiat currencies.
And there's other mechanisms in play as well. If you look at, we just wrote about it in the last issue. If you look at European equities, for example, and how they've underperformed US equities, there's a very good reason for it. The very good reason is because the Europeans have gone massively socialist. And so the returns that you can get from companies in Europe are dwindling. We just talked about Volkswagen and all of the European car manufacturers down in terms of like production, down 90%, 80%. I mean, catastrophic numbers, absolutely catastrophic. And so why would you invest in these companies, even if they're cheap? If they're going away, like, you don't invest in something that's going away.
Yeah.
And so, but then the question is, especially, and this is particularly important for Western capital, because what you got to remember is your financial capitals of the world have been basically Paris, Berlin, London, New York, Tokyo to some degree. Those money managers, they live very much in a Western dominated world, because that's what their world has looked like since they've been around for the last 20, 30 years, or whatever the case might be. So they shift capital between those sectors. They're not very happy to go and shift money into, I don't know, Uzbekistan, right? They're going to move it from London or Europe bourses to North American ones, backwards and forwards. They're not even comfortable to go into Argentina or Brazil. That's emerging market, guys. The main capital in the world has been centered around that Western-dominated sort of ecosystem. So now, when you have the European markets performing so poorly, the alternative is US. Right? So we could sit here all day and go, hey, you know what? US markets are overvalued. Would I short them? No.
Right.
Because there's a whole lot of other dynamics in play. Namely, if Europe continues down the path that it's going down, where's the capital going to go? It's going to keep going into the US. It has to. Where else is it going to go?
Yeah.
That in itself is also dollar positive.
Yeah. For a lot of huge pools of money, they just don't have the option to do things that the retail trader or investor, they don't have those same options. And therefore, it almost becomes like a TINA type of trade for them, where there just flat out is no other option.
You need liquidity, George. You need market caps that are in the billions. And you, in many instances, they've got certain mandates to their own LPs.
You need a deep liquid bond market. And there's so much of it. I guess it's not, there is no other option. There is no other alternative. I want to get my, acronym right. So guys, let's talk a little bit about the webinar that we're doing on Thursday. We went over just kind of everything from a 30,000 foot level, but on Thursday, we're really going to be getting into the weeds. We're going to be talking about specific companies that you guys have in your portfolio right now, and why you guys have purchased those companies. And then we're going to further our talk, of course, with global macro, the dollar, commodities, etc. So guys, if you want to participate there, Josh has just put it on the screen. Just go to georgegammon.com birthday. Now that's for the virtual conference that I'm doing, but that just puts you on the email list where we'll send out the link for this webinar that we'll be doing on Thursday, 3 p.m. Eastern time. So that's something that you guys are not going to want to miss. Put that on your calendar. Make sure you sign up right now at georgegammon.com/birthday. You're just going to put in your email list. And then within the next, probably tomorrow, we'll go ahead and email you the link for the webinar. Now, keep in mind, when you sign up for, or when you put in your email, you'll automatically get the link to the birthday, the conference, and feel free to attend that as well. But then that's a separate link from the webinar that you'll be getting for Thursday, 3 p.m. Eastern time, the deep dive that I'm going to be doing with Brad and Chris. So guys, on that note, I sure appreciate your time, and I really look forward to doing this again on Thursday.
Great. Thank
Can't
you.
wait.
Thanks, George.
Gonna be good fun.
Yeah, and sorry for waking you up at 6 o'clock in the morning, Brad.
That's all right. It's not so late now. 7:30.
He grew up as a farm boy. It's late.
Yeah, yeah.
All right,
Days.
guys.
Thank
As
you.
always, make sure that you are standing up for freedom, liberty, free market capitalism, and we'll see you on the next video.